Thanks for clicking. The Bank of Canada has just released its 2022 Financial System Review, outlining the main vulnerabilities of Canada's financial system.
This isn't going to be pretty.
The review goes over Canada's real estate market and looks at the impact of rising interest rates on mortgage payments, finding that the median mortgage payment could rise by up to 45% in just a few years' time. This comes at a time when rising mortgage rates are already having a major impact on Canada's real estate market, with Desjardins predicting that we're going to see a 15% drop in the real estate market, Capital Economics saying we could be looking at a 23% drop, and RBC saying we could be looking at a 30% drop in a few years' time.
You need a lot more than that.
So what I want to do today is look over the Bank of Canada's Financial System Review, specifically looking at mortgage payments and how they will be affected by these higher interest rates, and then take a look at what to look for next. Speaking of what to look for next, we are waiting for the release of Canada's inflation rate, which will obviously have a big impact on how fast and how high the Bank of Canada raises interest rates for the rest of the summer. We'll obviously have updates out on that rate on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into this review. The bank's review starts by looking at how many mortgages there are in Canada, showing that 28% are owners without mortgages, 37% are renters, and 35% of Canadians are homeowners with a mortgage. 25% of Canadians have fixed-rate mortgages, whereas 10% have variable, and with those 10%, 8% have fixed payments, and only 2% have payments that fluctuate with prime. So they have adjustable payments. When prime goes up, so do their mortgage payments. And this is good news-ish so far, as only 2% of Canadians have seen their mortgage payments go up in the past few months as the Bank of Canada has raised interest rates. However, the review then moves on to look specifically at mortgages obtained between 2020 and 2021, when Canada's real estate market skyrocketed and we had ultra-low interest rates. The bank found that during the past 2 years, there were 1.4 million mortgages taken out, 540,000 of which were variable rate mortgages. And this really points to what we knew all along. Variable rate mortgages increased substantially throughout the 2020-2021 home buying period. While 28.5% of all mortgages are variable, 39% of those mortgages taken out throughout the pandemic boom were variable rate mortgages.
Throughout the pandemic, a growing number of Canadians took out mortgages that were very large relative to their incomes at variable rates with amortizations of more than 25 years.
So a major increase in the use of variable rate mortgages throughout the pandemic home buying boom. Obviously, an increase in interest rates doesn't mesh well with an increase in variable rate mortgages. But the real problem comes when we look at the data and see that those who took out high loan-to-income mortgages, those mortgages that were 4.5 times the borrower's income, were far more likely to take on variable rate mortgages at 31% of variable rate holders. So 31% of those who took out variable rate mortgages had high loan to income ratios. In contrast, only 16% of those who took out fixed rate mortgages had high loan to income ratios. Of those Canadians who took out relatively high mortgage amounts, relatively high to their income, they were twice as likely to take on variable mortgages than they were to have taken on fixed. So, according to the Bank of Canada, it was those who were most indebted, those who were least able to take the swings of a variable rate mortgage, that took out variable rate mortgages.
I told you this was dangerous.
As a result, it's going to be those same high loan-to-income mortgage holders that took out variable rates that are going to feel the biggest pinch when mortgage rates go up. They are going up, but in 3 or 4 years, when those 2020, 2021 mortgages come up for renewal, these variable rate mortgage holders are going to see the biggest swings in their payments. According to the review, if you took a fixed rate, and the Bank of Canada is projecting mortgage rates to be at 4.5% in the next few years, if you took a fixed rate, the median mortgage payments will be rising by about 26%. In contrast, if you took a variable rate, because your rates were so low, because your payments were so low at the time of purchase, we could see a swing of up to 45% higher mortgage payment come 2025-2026. This could result in higher payments to the tune of $1,000 more than variable rate holders are currently paying right now. And I think this is even more concerning when you consider what we talked about at the beginning of this video. that the majority of variable rate holders don't have adjustable payments. So, as rates continue to go up over the next few years, more and more of the payments currently being made are going towards interest, which means the principal isn't being paid down. So, in 3 or 4 years, when these mortgages come up for renewal, buyers or the holders of these mortgages aren't going to be in a position of having very much equity. That's going to severely limit their choices in shopping for lenders, in refinancing, in their ability to handle these higher interest rates. And I think Tiff Macklem at the press conference pointed this out, that this is a big vulnerability for the housing market.
But high household debt and elevated house prices are vulnerabilities. If the economy slowed sharply and unemployment rose considerably, the combination of more highly indebted Canadians and high house prices could amplify the downturn.
I mean, yeah, the worry is that the holders of these variable rate mortgages, especially those who were stretched to begin with, will be unable to make their $1,000 extra a month payments and will, as a result, have to sell. And when we have a flood of new properties hitting the market, that's going to put even more downward pressure on our real estate prices.
Good.
Which, yeah, I understand. If you've been waiting to get into the real estate market, a crash sounds great. But a total real estate crash isn't as fun as it sounds and carries with it a whole host of other economic problems that go well beyond the real estate market. So, while first-time homebuyers may be interested in a slowdown, I don't think a crash is going to be that great for very many people. And with the households so highly indebted, taking on these variable rate mortgages, in 3 or 4 years, we could start to see a big problem as those mortgages come set to renew. We'll obviously have updates out on this channel, how all of this plays out in the coming months and years ahead. Make sure you click like and subscribe to get those updates, but for now, thanks so much for watching.